Hi, I am Rohan Sharma, your mentor in this program. Today we discuss venture capital in private equity. Those who are very interested to understand how venture capital works, how the private equity help the startups or angel investing companies, then this lecture is for you. So let's discuss the venture capital in detail. So now we discuss venture capital investments in detail. So venture capital investments is a type of a private equity, a form of a financing that is provided to the small, early stage emerging firms which have a very huge high growth potentials. Big firms or investment companies have an eye on the small or emerging companies that have a high growth potentials in terms of number of employees or annual revenues or both. The big firms are putting their investments in the emerging companies which can create a big business in a future terms. There are various features of venture capital investments that we discuss in detail. The venture capital investment is a high risk activity. There is a lack of liquidations. If the company is not performing well, there is a problem in liquidations. The investment will be for long time horizons. Equity participations and capital gain will be applicable on such investments. Venture capital investments are made in innovative projects. So these innovative projects sometimes works and sometimes don't. Supplier of venture capital participate in the management of the company. These are the basic features of a venture capital investments. The venture capital investment participate in a company or funding in a various types. They can purchase the equity, they can participating in debentures in the form of loan, or they can give you a conditional loans with certain terms and condition attached with it. Now we discuss the funding process by venture capital. There is a very simple venture capital process. The first important thing is fundraising. The source of capital from banks or a corporation of funds done by the venture capital. Venture capital is basically a mediator which apply the funds, which take the funds from the big banks or insurance companies and putting it to the new emerging companies which have a high growth potentials. So the first step in the fund process is that the venture capital take the fundraising or take the source of capital from banks and the big firms. Then they evaluate the venture opportunities. They find out the emerging companies which are providing a high growth potential and have a great idea. Then the third thing, they invest capital into that enterprises. The fourth, they governing the business, a profitable growth into it. The fifth, they look for the exit. They're generating liquidation through IPOs or transfer the shares to another venture capital. And the fifth thing, they distribute returns to the investors. The big firms or the banks that putting the money in venture capital, they again distribute the returns to them. So this is a simple project. This is a simple process of venture capital that they can be processed towards the investing. The type of funding by the venture capital will be categorized into three parts. The first is the early stage financing. The next one is the expansion financing. And the third one is acquisition or buyout financing. The early stage financing will be subcategorized into three parts: the seed financing, the startup financing, and the first stage financing. Seed financing is a small amount that the entrepreneur receives for the purpose of being eligible for startup loans. That means the company is only providing such amount that the company will be incorporate and do the basic activity before get a startup loan. Startup financing is given to the company for the purpose of finishing the development of product and servicing. The company is incorporated, the idea will be created, that idea will be converted into development of products and services. For that case, the companies provide the startup financing. The first stage financing is companies that have spent all their starting capital and need finance for beginning of the business activity. The full scale of the major beneficiaries of the first stage financing. It means company incorporate, create that idea, look over the ideas, it can develop the product and services also. Now the product and services are ready for an expansion stage. At that time, the first stage financing will be finished. Now the company is needed for an expansion funding, that is also called as second stage financing, is provided to the companies for the purpose of beginning their expansions. It is also called as mezzanine financing. It is provided for the purpose of assisting a particular company to expand in a major way. Suppose if a company is developing a good product, have a monopolistic in the markets, now they want to spread in all over the world, then the companies start with the second stage of funding. Bridge financing may be provided as a short-term interest only finance option, as well as a form of monetary assistance to the companies that employ the initial public offer as a major business strategy. In the second stage financing, the company increase the size of the enterprise, and the major focus is to create a great turnovers. After the turnovers, the company is looking for an IPO, initial public offer, as a major business strategy. The third important thing, or the third stage of the funding, is acquisition or buyout financing. Acquisition or buyout financing is categorized into acquisition finance and management or leverage buyout financing. Acquisition financing assists a company to acquire certain part of the entire company. So suppose if I already done first stage and second stage financing, company is doing well, is doing exceptional growth, now I want to become a partner of that company. So I acquire certain part of entire company. Management or leverage buyout financing help a particular management group to obtain a particular product of another company. If a company wants a product of another company for the expansion or for a great deal, they can go for the acquisition or buyout financing. Every venture capital have a major target of creating a wealth, and this wealth will only be eligible when they get a proper exit route. So the venture capital investors get an exit route either through initial public offerings or promoter buyback. They also look for mergers and acquisitions or sale to the another venture capitalist. There are various advantages of venture capital. They bring wealth and expertise to the company. Large sum of equity finance can be provided to their businesses. Business does not stand with the obligation to repay the money, so it is a best chance that you can become a partner on the growing company. In addition to the capital, it provides the valuable informations, resources, and technical assistance to make a business successful. There are some limitations of venture capital. As an investor become part owner, the autonomy and the control of founder cost is there. There are various limitations of venture capital. As an investor, we are become the part owner of the company. The control and the autonomy of the founder is lost. That means you have to compromise with your management control. It is a lengthy and a complex process. It is uncertain form of financing. It will be wholly depend upon the performance of the product, idea, and the company. Benefit from such financing can be realized in long run only. There is no short-term financing solutions in a venture capital. Now we discuss the basic difference between private equity and a venture capital. Private equity, PE firms buy mature and public companies. Those companies which are already at a certain stage, which create a great turnovers, the private equity directly enter into the developed company or that company which already create or get over the stage of the venture capital. Whereas the venture capital invest in a very early stage companies. Private equity firms buy companies across all industries, whereas the venture capital are focused on technology, biotech or a clean tech companies. It is seen that the private equity firms almost always buy 100% of the companies in a LBO, that is leverage buyouts. Venture capital only acquires a minority stake, which is usually less than 50%. Private equities make large investment, say $100 to $10 billion, whereas the venture capital make a very small investment, which often below 10 millions in early stage companies. Private equity firms use a combination of equity and debt in a company, whereas the venture capitals use only equity or cash in a. I hope so you enjoy this lecture. We conclude the venture capital and private equity lecture in 3 major points. The first important point is, for the venture capital investment, you should have a long-term horizon. The company should be a great idea and it can convert into a big business. The second important thing, the venture capital is always put the money into early stage companies, and basically these companies are belong to biotech, technology or clean technical companies. Private equity is only put the money in the form of equity or debt to a developed company or a company which is already in a very good size, whereas the venture capital is always putting the money in early stage companies. Thanks a lot. Enjoy the lecture and have a nice day.